Hey guys, how are you? Yes, a bit late with the gold update. Apologies for that. I was off grid, had a lovely weekend away, but no Wi-Fi, no anything at all, and then took a while to get back hooked up. Anyway, here's the gold that I'd mentioned Freeview that I would do, and this was the chart that in the tweet that I spoke of. So what is it that we're looking at? We're looking at 1 gold ounce buys you how many silver ounces. This is the simple relative valuation for gold and silver. But it's more important than just the one versus the other. It is also an extremities indicator for overall bull markets and bear markets. In short, when you get to an extremity in value of gold relative to silver, like we are in right now, you are at the most undervalued that precious metals are typically to be. Now, many will say, but silver is partially industrial. You know, you got it on all these prisoner tag devices that you're carrying around with you voluntarily. This laptop I'm recording on, in this hotel, in the mic that I'm using, etc., etc. So there's an industrial use, but it also has a bullion use. That bullion use is reduced a little when you're in the everything's okay normal economic environment and you're being paid actual interest on your money in a normal savings environment. One of the big arguments Buffett, that who always and I lost all respect for him, he's such a control structure stooge, said about gold is that it doesn't pay you interest. Well, when you're in a negative interest rate environment where many things cost you money and there is proliferation of currency, actually having something that doesn't pay you interest but can't be proliferated is exceedingly useful, and it is a call option on central banking failure and future proliferation. That's precious metals generally. You just can't print them, unlike the others. And the fact that you might have storage costs, personally dig a hole in the ground in your back garden, doesn't have to be that expensive. I don't believe in on-grid solutions, is a weak argument. And there is no interest being paid on your money anyway, generally. And you can store your metals real cheap if you're creative. Just with a bit of energy, sweat, and burn a few calories, and that's the only cost. And the difference is when you dig it up in 10 years time, it'll still all be there. It won't be proliferated away and have half the buying power. So here's the thing, when we are at an extremity, if I use the pen and do a little bit of scribbly drawings for you, this is new territory. We hit new territory for the first time in 2009 as the great solution to our debt-induced problems first came out. Guess what? We didn't cross 90. We didn't cross 90. That was the low of value. Now, gold was in and around at a hit a low of 689 and silver was sub $8 at that point. The subsequent collapse of the gold-silver ratio was the introduction of quantitative easing that saw us go all the way down to 30 from almost 90, 89 to 30. Now that saw silver go all the way up to just under $50, $49 an ounce, and gold run from 689 all the way up to 1927. That move right there, this is an electric fence, this 90, and in fact there's a bigger one at 100, you can imagine, but we've never been there. Now in the modern era, this 30 was the bounce point, and then they put in, you know, their reflation techniques, etc., etc. We never fully reset. In fact, long enough historically back, the ratios were far lower for gold and silver. But I don't want to get hung up on that. This is the range of the modern era, the extremity. In other words, you've not traded 1% above that until literally now. And I will come back to this. And you've not traded 1% below that since the 2007 property boom. Now, there's a lot longer history. This chart, unfortunately, doesn't provide it. And as I've said, each time the credit cycle has been expanded, that gold-silver ratio has been pushed up. If it were to correct all the way to long-run historical levels, that's a whole different ball game altogether. Let's not even go there. But believe me, it'll be further bullish. So in technical analysis terms, you had a squeeze there. This was the great loss of value of gold to silver. Gold started to have a bit of a move off the 2001 lows, and silver was lagging, and then property was the whole thing. Then the crash came, everything lost value. Actually, gold and silver prices went down, and the gold-silver ratio spiked. Then the QE solution came, and then we reverse dumped to here. Proliferation is the new game. Now, technically speaking, this right here has been the better part of, and the top was around about September, I think it was 2011, just after summer going into the winter, in the northern hemisphere anyway, right the way through to where we are today. Essentially, you're looking at nearly an 8-year, past 7-year mark, 7.5 plus, rising wedge of the gold-silver ratio. Non-stop ascent. In other words, the relative devaluation and undervaluation of overall precious metals, and specifically more silver to gold. But that's the subplot. That's the subplot. So what's actually happening is we are now in new territory, historically never done before. Relative valuation, undervaluation of precious metals to this measure to silver. So on the measure of silver to gold, we're at a new territory. This is Vikings past the last known land and wondering if the end of the world is over the horizon on the ocean. No man has gone before. And this is where we're at with silver and gold. Now, technically, this is where the fundamentals and the technicals and the relative value assessments all come together. Is rising wedges resolve often with a final melt up. So with that, I highlight this. And even an exhaustion pop out the top, where you could get a nice shooting star. And then often, they don't have to do this, by the way, but they often can. So you have an absolute further melt up. And remember now, the central banks have been buying gold. China, Russia, the big institutions and the corporatocracy and the control structure, governmental agencies can't buy silver for bullion because it would take too much storage to park up a decent amount of value. Plus, the market is thin in liquidity. It's like you've got to invest a 10 billion hedge fund. If you're in a crypto market, you're not buying crypto 1,300 that trades a couple of $1,000 a day. You're buying Bitcoin. And in that essence, gold is the higher volume and the easier storage. A greater amount of value is compressed into a smaller amount of space, which when you have to store it is of critical importance, especially when you're a state. But what follows that is the peasantry that can't afford gold, that buys a little bit of gold and tops up with buying silver, because silver has bullion value as well as the industrial value. Even gold has a small amount of industrial value, and I'm not talking about jewelry, I'm talking about use in extreme electronics of high value, etc. for its unique properties. So what does this mean? This means that we're at the beginning of an end game melt up for this relative valuation that could end with this kind of very abrupt. You go from 2009 extreme ratio. This was the last all-time high between the ratio for the modern era. For the modern era, this history, the last two and a half decades, not all of history. And this is if we have the full-blown reset, the potential for how far we may end up going right down. But that's your bonus card. Forget the bonus card for now, to 30. So you've gone from 90 to 30. That's a 3x in relative valuation for silver at a time that gold itself was running. Gold itself was running from 689 at the lows of 2009 to 1927. So you're talking about something that 3x'd against something else that was 3xing. Yeah. So that's essentially 9 times. And it's a great grower. Then you get things like mines. Marginal mines will give you an even bigger pump on stocks than big names that are profitable at any price level, because they go from being non-profitable, only slightly profitable, to substantially profitable because their marginal costs are higher. So that's an area for you to explore. I've already given my premium community a great cross time zone setup, silver equity, that we really like, and they're going to be filling their socks, and later on our YouTube I might share that as it progresses with you to consider. But go and have a look at this. Let's have a look now at silver, and I want to make a couple of comments that again I gave earlier to my premium community. By the way, feel free to go to the website, book a call to have a chat if you'd like to become part with us. It's not for everyone, but it is very helpful, and you will have a community of like-minded in this reset world. We're doing some awesome reset stuff as well for preparation. This is happening, guys, right now. This is the beginning of the big fall over. These things that are meant to move are starting to move. This is the failure. This is the U-turn on the debt that's seeing now the dollar currency games. It's seeing the interest rate turn. You've had the yield curve inversion. Everything I've spoken about in my YouTubing history about there is a big reset coming is now. It's in the here and now. How you position and how you play this period is going to be a seminal economic history case study. Yes, you're making history. They're going to go in 300 years from now and say, what on earth were those thinking? And that was such an obvious trade. Why didn't everybody do it? Do not be left behind. Do not be left behind by having deer in the headlights during this period. Yeah, the obvious is there, and you can position for it. So the key element about silver and how it differs to gold, I will go to gold now because we're a gold bull, is that this is getting exceedingly tight right now, and you've had support, marginally lower lows here, marginally lower lows, and now very tight. You had a little attempt to get away. No, it came back down, but failed to make new lows, $14 holding for silver. Then you had a bump, a drift, and now you are here. This is low volatility at a basing out low. Now, calling reversals is a mug's game. Most people lose doing that. But there's certain things when things do reverse, and that was not it. That was high volatility, descending triangle. It pointed to further sell-off. What you get is smaller candles, spinning tops there, smaller candles, drift up, drift back down, smaller candles again. Then the green candles bit longer, and the reds taking a lot longer to get back down, a bit smaller. This is actually potentially leg up, drift down, and then ready for another leg up called the 3 rising method tactical. Candlestick pattern. You'll learn a lot about this if you come on a program. Anyway, all that aside, low volatility in silver, but no clear reversal, although I believe, or I assess, let me change that word, I assess that that is on the way. It is on the way. Why? Because of its bigger brother metal, and the fact that the central banks are moving first because they know the game. They have done that. And that's where you are on the central banking cartel. And again, a squeeze and a setup occurred, and you can see it right here. And we were on it. It wasn't the most beautiful initially, but there you go. It started to get really strong. Little drift down. You see that leg up and those little drift down, and then the pump and the break. I've just shown you silver. It looks like the movie just before this one that you're waiting for the break. That is your break of this structure pattern. And this also had a neckline level here, left shoulder, I've discussed head, and then an overall right shoulder somewhere here. You can make this all part of your basing out head and your left shoulder. And you had at 1350, a key level. Every time you came up to 1350, you were resisted. 1350, you should draw that on there. Every time, even on the way down, it was showing its key level of significance each time, and now you're broken above it. What was previously resistance turned support, etc., and again you're squeezing for your breakout, particularly strong near the end where it needed to be to set up your spring up. So this is a basing out turn, and this has seen gold go up in value without the silver following, although silver is squeezing as well and getting ready. You're telling me silver's going to break down now? I don't know. as a betting man, if it's going to break, it's going to be to the upside and it's going to follow its bigger brother. I would call that high probability assumption. Not a guarantee, high probability assumption indeed. What else can I show you? If we drop to the 4 times time frame, we actually have within that break above the 1350. So go back to the draw tool. Let's pull this down a bit as well and pull it along. Go back to the draw tool, get the pen up, Francis, show the guys what you want to tell them. So you had your 1350 line way down here now. You can see how this is quite some way below. Beautiful little structured setup in there, by the way. We picked that, we traded that. You missed it because you're not in the premium community. Too bad. Never mind. When you're ready, you'll do it. Otherwise, maybe it's not for you. That's all cool. You get your free view YouTube. Enjoy. Third high. Third low, this could ease a little bit. This could set up a squeeze within a squeeze in time. And my suspicion is you're going up again at some point and you might take your next rest at 1465. You might overperform, go straight into overperformance and start overperforming. So gold is an alarm for failure it's the canary in the gold mine, for want of a better phrase. It starts to chirp and it's starting to get gassed. It's time you get the hell out of there. It's your insurance policy against system failure. It is going up. The system is in a failure state. It is in its debt spiral. They are going to devalue, etc., etc. So what you want to look at is saying, wow, we're getting upside setups all the time. We're getting volatility. Look how strong the legs up and the drift downs. They're battling to keep this thing contained and it's getting out of hand. So you will watch and see what's happening on the shorter time frames. My suspicion is compression, lots of compression, further compression. Will compress and compress and you'll see the last move quite high momentum here. What I suspect will happen is that you'll get quite a lot of compression in here. Squeezing, squeezy, Japanesey. Getting really, really tight. By the time this runs, you're almost too late. And that is the situation with bullion. We've got an amazing equity. As I say, that's in our premium area. That's going to get a big fillip out of this case and story. But go and find for yourself. Go look at your marginal equities, your marginal minor equities. Equities are going to go up generally. FANGs, Russell, I've said it before, I'll repeat it again. The overall, in this perverse economy where the valuations are absolutely distorted and there's proliferation of money, the billionaires will get richer by an ongoing expansion of liquidity, which will go anywhere where there's any form of yield because the money has been given away for free, almost without any costs associated, even negative costs associated. If you're an institution, corporatocracy, or a billionaire, you don't get to borrow at negative interest rates. Sorry, guys, you're part of the peasantry. You know, as George Carlin said, it's a nasty little club and you ain't in it. But others do. Big companies do. Big billionaires can. They can leverage up to the hilt and they can just buy stocks. And the FANGs are going to go. They're looking strong. So you can certainly look there. But that's hold your nose investing because it stinks. You know it's wrong. It's going to go up just because of the perversion. Why not get something that's going up but is fundamentally justified in going up so that if the reset suddenly happens, boom, and you crash down on all your equities, the one thing that will actually has valuation attached to it, which will be strong, could continue to go up rather than that. I mean, I love Real Vision and all of that, but just to say buy bonds because they're going to go up, it's debt. There's too much of it around. What if it suddenly stopped the clock and they set them all to zero and you're the bag holder at the end? It's kind of technically like buying the melt up in the dot-com boom in 1999, having missed the run since 91, 92, 94, 95, 96 when he said irrational exuberance, and you go, what the hell? You buy it because it's going up. the fact that it's not worth what it is doesn't matter. I can't get around buying bonds. You have no way how the control structure will do. A debt jubilee may not be in your favor as a bond holder, as someone holding the debt, as a pension. It may all be written off and you hold the bag. While gold is gold, silver is silver, mines that pull out gold and silver will be mines that still pull out gold and silver after all of this goes down. So for me, you've got to avoid buying. You've got to be careful about buying the things that can only go up. You can make money on it, but suddenly the music stops, and then you've got your Facebook shares at 100 times PE, and you bought it at 99, and they crash right back down to 5p, 10p, 15p in a major depression. Who knows? And what are you left with? This is precious metals. Welcome to precious metals. Welcome to something that actually is scarcity, real scarcity. And even for the crypto guys, and I'm a crypto guy to a point, I'm not a believer, but I'm an assessor. And there is certainly a value to be had in the convenience of the electronic money. Bitcoin is not limited. If Bitcoin Cash can exist and do very similar things, or Litecoin can do very similar things. Some will say, oh, but they don't have the Lightning Network, they don't have this. Forks is quantitative easing. These all lead to new electronic money. Hashgraph replaced blockchain. Boom, 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 bosh. Gold doesn't die in that sense. And that's the downside of the cryptos and these other realms and this debt and all of this e-money. Electronic money. Tangibility matters, but you don't get the convenience. Okay, that's my story on metals. Play safe out there. I'd love to show you the equity, but as I say, respect to the premium community. If you want to find out about this one, I'm going and have already gone long on it. There will be others. Go do your own research. This is not a recommendation. I sense that we're going to have a dull period actually with gold now. This is actually a little bit quiet. It's going to be boring, and the quiet before the storm. The low volatility before the high volatility expansion. There's your grinding line. There's your squeezing. You're already in a structure. And that structure is already in an inverted structure that you've already broken. So you're not the first to the precious metals boom, but it's far, far from late. This is only the beginning of the beginning still. It's not even the middle part of the beginning. It's not even the end of the beginning. It's still pretty early in the beginning of the beginning in terms of where this has got to go out. Think of all that fiat squeezing into that limited amount of precious metals. Ask yourself why China and Russia are buying all up as central banks and have been doing for a decade or so, while America has kept the cheap discount window open for want of them not dumping their treasuries at key moments. Yes, there's a deal, and a tacit deal if it's not explicit. I see conspiracy in many things, but this is a chance that you can buy at this price too. Okay, without any further ado, that's my take on the precious metal market. Bull, bull, bull. Bull, silver as well if you want to get in earlier, but gold will run first and foremost. I think we could still see possibly 100, maybe 95 on the gold silver ratio in a melt up, but once it turns down, it's going to be all about the silver. Check your miners if you like equities. That's the long and short of it all. Bye for now, and remember, hit the bell to subscribe so that you get your alerts. Hit the bell, and if you're interested in developing as a lifestyle trader, you can book in to have a chat with one of our guys, an existing HVF trader for over 2.5 years, and he'll talk you through his experience and tell you all about coming on board and being part of our community. Till next time, bye. Enjoy yourself, trade safe.